Welcome back,
quarantine.
everybody.
Yeah, what's up? Everybody's surviving. Okay, so this is going to be monetary policy. We need to quickly review the structure of the Fed. So remember, I call this the love triangle. Okay, so in my love triangle, if you think about you've got this Federal Advisory Council. So, like in my classes, we looked at beige books. We looked at all 12 districts of the Federal Reserve. So, you got what we call the FAC. They're advisory. They give advice. Okay, so they track over here, and the first people they give advice to is the Board of Governors. We put them at the top because they're pretty important. There's 7 members here. So, in these 7 members, they're also going to be a part of something else. And this is the important part. This is the FOMC, Federal Open Market Committee. And inside of this, you have these 7 members, okay? So if you think about this love triangle, you've got the Advisory Council who looks at the beige book, they look at the health of the economy, and they say, okay, and the biggest thing that's been happening is the coronavirus. So monetary-wise, they say, oh, we need to stimulate the economy. They go over here to the Board of Governors and they say, you know what, you're right. We need to go meet with our other 5 district bank presidents. We need to meet with them because now you got these 7 members from the board, plus you're going to have the 5 president, or the president of the district banks, okay? The one that never changes is the one from New York City. The other 4, they kind of rotate. So it could be from Dallas, it could be from Chicago, it could be from Atlanta, it could be wherever, but they rotate. So those 5 presidents of district banks makes up 12. So if you think about this, in the FOMC, they're the ones that create the monetary tools. They decide on the tools. There's 4 tools that we're going to talk about in just a second. But they decide these tools, and then what they do is they create the monetary policy. So you've got this love triangle where it says, oh my goodness, we have a problem. Houston, we have a problem. They go to the Board of Governors and they say, okay, you know what? You're right. Let's go talk to our others over here on the Federal Open Market Committee, and they're the ones that create the monetary tools that we're going to talk about. So let's dive in for a second. The very first one that we have is called reserve requirements. So in our reserve requirements, it means what it is required to reserve money. So if I have the Fed over here, I'm Grady Bank, okay? I'm the member bank, I'm here, and then I'm also kind of playing tug of war with my consumers. So if it's a tug of war between the Fed and the consumers. Do we want to put more cash out to consumers through loans, or do we want to keep the money off the streets? Well, right now, we want to make sure in our coronavirus state, we want to make sure that we want to put money into the hands for people, because people with their jobs being lost, or people having to be in quarantine. A lot of people are spending money on supplies for food and things that they need to stay in quarantine. So we need to make sure that we have cash on hand. So when that cash goes to the hand, there's going to be demand for stuff. There's going to be more consumption. Well, we need to make sure we can get that to the consumers. One of those ways is that through loans. And banks make their money through interest rates on loans, which we're going to talk about in a second. But with reserve requirement, the first thing that banks have to do is they have to make sure that when every deposit comes in, they have a certain percentage that they have to keep in the vault. They keep it in the bank vault. And so if that number is high, that's less money that they can loan out to consumers, okay? So if this percentage is high, then that's less money over here. But if I lower the amount that I'm required to keep in my vault, that creates more money that I can loan out to people. So if the Federal Reserve, if they're trying to grow the economy, they're trying to expand it and grow, you would think, okay, let's lower my reserve requirement. The reason I have to lower it is because now I have more money out for my consumers. On the opposite side, if I slow it, well, it's just the opposite. They would raise it. So they would raise the actual requirement that me as the bank has to keep in my vault if they want to keep the money off the streets, okay?
When you think about that love triangle with the Federal Reserve, just think of it like any other part of our government. We're a federal system, so we got local, state, federal government, because we want all parts of the government to be represented. So on the Federal Reserve, it's no different. The Federal Advisory Council represents the regional areas. So think about the last hurricane that came through, right? The Atlanta district, Florida and Georgia and areas like that, we had a high demand for cash. But the St. Louis area didn't really at the time. And so we've got to be represented on the spot. At the same level, we need to have the same plan nationally. And so that Federal Advisory Council advises the Board of Governors, and together they make the big decisions. So we've got the regional level represented, we've got the national level represented. That way it's a little bit better of a mixture.
Mm-hmm. Go ahead and click if you don't mind.
All right, so the next tool that we're going to look at is the discount rate. All right, and so this is affecting all of us right now. Let's remember that this discount rate is the interest rate that the Federal Reserve charges banks in order to borrow money. So whenever I went to buy my house, all right, I had to borrow money from Marshland Credit Union. Well, chances are they don't just have $150,000 lying around, so they'll have to borrow that from the Federal Reserve. That's where we come into the discount rate. All right, so as of a week ago, that discount rate was 2%. Meaning that if a bank borrowed money from the Fed, they had to pay 2% on it, which means any interest rate that they're going to charge somebody has got to be higher than that 2%. So last week, the average interest rate on a home mortgage was about 5%. All right, as of day before yesterday, they dropped the discount rate down to 0. All right, so they've cut it by 2 percentage points. Then that means that now that mortgage is going to cost about 3 or 3.25% interest. So doing the math there, that's going to save you about $3,000 or $4,000 a year. Add that up over a 30-year mortgage, that's $90,000. And so by lowering down that interest rate, they're trying to get people to buy houses. And honestly, for my students at least, I've shown you all the house that my wife and I want to buy. Like, I'm trying everything I can right now to get my wife to buy that house. I've got a full month to move into it. All right, so by lowering down that discount rate, they've increased our demand for the house. They're making it more likely for us to buy it. But on the other side, the Federal Reserve will raise that discount rate sometimes. All right, and the reason that they'll do that is to lower down the demand for goods. Usually it's when inflation starts to get out of hand. So we see something really cool. Over the past couple of years, a lot of expansionary policies from our Congress and our president. Big tax cuts, a lot of spending. All right, but at the same time, you have the Federal Reserve using contractionary policy. So you've got the president and Congress with the foot on the gas pedal a little bit, and you've got the Federal Reserve kind of on the brakes, making sure we don't grow too quickly, too fast.
And they might get in a Twitter war.
Yeah, that happens sometimes.
All right, go ahead.
All right, open market operations, in my opinion, is the most confusing of them. But just think about it as lending people money, right? So last year, we had my nephew's baptism, and I took out a savings bond for him. I bought a treasury bond. It's for 20 years, and it gains 3% interest per year. So it's for $100. So by the time that he's 21 years old, it'll be worth about $160. So for the next 20 years, my money supply has dropped. I can't spend that $100 anywhere else. So when they sold me that bond, my money supply has shrunk.
Yeah.
But when my nephew turns 21 and they buy that bond back, now he's going to get that money, he's going to get all the interest, and hopefully he's going to use that money responsibly. So whenever the Federal Reserve sells those government bonds, it slows down our economy. They've got the cash, you've got that nice IOU note, you can't really use it anywhere for a little while. But when they buy that bond back like they're doing now, it pushes a bunch of money into the economy. So last Friday, they bought back about $1.3 trillion worth of government bonds. So that means that people have $1.3 trillion more money. They could go buy a bunch of toilet paper with it, or they could put it into their savings account, whatever their prerogative is.
Absolutely. And if you think, buy big, sell slow. So if you're trying to grow and expand, you would buy those bonds. And I mean, not you as in you, the consumer. I'm talking about the Fed. The Fed would buy bonds. Buy big and sell slow. Okay? All right, last one. Interest on reserves, okay? This is one that came out after the 2008 recession. It's a newer one. It's not one you see a whole lot, but it kind of works the same way. So you have this excess of reserves as a bank. So as a member bank, I have this excess. I've met my requirement with my reserve over here that the Fed has given me. And so I've got some choices. I could basically sell my money to the bank or to the Fed, or I could loan it out to consumers. So I'm going to go with which one's going to offer me the biggest interest rate. So if I'm looking at the Fed and the Fed says, we're only going to offer about maybe 1.5%, okay? It's class change. So at 1.5%, then I'm thinking, maybe not. I could charge my consumers over here, I could charge like 3%. So I would make more money on my interest if I go over here to consumers. So if you think about it, if the Fed lowers their money their interest they're going to pay me as the member bank, if they lower that interest on reserves, then they're saying don't come to us as the Fed, go to the consumers. So they're lowering it. If you start to look at this and look at how this is happening, on the growth side, your arrows are all down. That means that if they're lowering reserve requirement, lowering discount rate, lowering interest on reserves to get more money and cash into consumers for consumption, and then you also buy big. So if you think about visuals, if you look at your arrows, well, they're going to be the opposite on slow for contractionary policies. So if the Fed increases the interest on reserves, the money that they're going to pay me, not money, but interest that they're going to pay me, then I might say, okay, well, I'll go to the Fed instead of loaning it out to consumers. So when they raise all of my arrows over here, when they raise these things, they're trying to get the money off the street and lessen the demand for cash. So they're trying to get that money off the streets. But if they're lowering everything, then they're growing it and trying to expand.
So think of it this way. If the bank would give you 7 or 8% interest on your savings account, would anybody ever buy stocks? Right? And so the higher interest they put on those reserves, the less banks want to lend out. That gives them more of an incentive to store money because there's no risk there just keeping it in their vaults.
Absolutely. Day 2, done.